It's Monday morning, you've just been paid, thoughts of new shoes, a new restaurant, or the latest movies are on your mind. But before you know it, your money is gone. On payday, it's challenging to figure out the best way to handle your finances. Today, I'm walking you through 8 essential steps to help you manage your money as soon as you receive it. Step 1. Determine your financial baseline. For most people, personal finance seems like too much work, which is why they struggle. 64% of Americans live paycheck to paycheck because they make one of the biggest financial mistakes known as mental accounting. This means mentally categorizing your money instead of actually writing it down. Luckily, the solution is straightforward. Open a spreadsheet and list all your monthly expenses, such as rent, internet, and groceries. Creating a Google Sheet can help you understand your monthly expenses. Now for the hard work, remove any expense that isn't a core necessity. This includes subscriptions like Netflix or gaming apps. You should be left with a few core expenses. Housing, whether rent or mortgage, should ideally be under 30% of your income, groceries and food around 10%, and insurance and utilities like internet and phone another 10%. This number now becomes your financial baseline, the bare minimum you need each month. Aim to keep your financial baseline under 50% of your total income. Knowing your baseline sets the stage for the next step. Step 2. Build an emergency fund. Imagine the kind of freedom and peace of mind you'd have if you had 6 months' worth of expenses saved up. Emergencies happen, and most people don't have a safety net. About 56% of Americans can't handle an unexpected $1,000 expense, and 22% don't have any emergency fund at all. I remember when my furnace broke down suddenly, leaving me with a $3,000 bill. Without any emergency savings, I would have had to put it on a credit card and ended up paying well over $4,000 after interest. Aim to save 6 months' worth of your financial baseline to cover emergencies. Emergencies don't include vacations or late-night food cravings. The money should only be used when a real disaster strikes, like if your house floods, your car breaks down, or you lose your job. Once your emergency fund is in place, move to the next step. Step 3. Eliminate high-interest debt. 77% of American adults are in debt, which has become the norm. Maybe we bought expensive clothes to keep up with a lifestyle we couldn't afford, or purchased new furniture instead of finding something on Craigslist. One of the worst things about debt is that it consumes your monthly income. If you're paying hundreds of dollars or more for your credit cards and car loans, it quickly reduces your ability to save and invest. Forget about cutting back on fancy coffee and avocado toast, because paying off high-interest debt will save you thousands in interest. For example, if you have a $5,000 credit card balance with an 18% interest rate and only pay the $100 minimum per month, it will take over 6 years to pay off, with an additional $4,000 in interest. What's the best strategy to pay off this debt? There are 2 ways. Tackle the high-interest loans first, like credit cards, payday loans, and car loans over 10% interest. This is called the avalanche method, which is the most cost-effective way to pay off debt. The other way is the snowball method, which focuses on the smallest loan first for psychological motivation. Consider using a Google Sheet to bring all your debt together and keep an eye on your payments. Seeing your debt gradually reduce to zero will encourage you to stay on track. After paying off high-interest debts, you'll have more room in your monthly budget, but before you do anything else, prioritize the next step. Step 4. Start investing. When people think about investing, they picture rapidly changing numbers on screens, frantic trading, and loud shouting, but it's actually much simpler than that. The basics are simple, and once you know them, you can make millions in your lifetime. Einstein said, "Compound interest is the 8th wonder of the world, and those who understand it earn it, while those who don't, pay it." Compound interest is why you should have started investing yesterday. The stock market returns around 10% a year, meaning your money will double every 10 years. If you invest $4,000 each year from ages 25 to 65 with an annual return of 10%, you'll have over $1.8 million. If you don't invest and keep that money in cash, you'll have only $160,000. That difference can change your life. The problem is, which investing account should you start with first? For most people, put money into your 401k plan, a workplace retirement plan which offers matching contributions, essentially free money. If your 401k offers this, contribute enough to meet the match. This not only gets you free money, but also lowers your taxable income. If you earn $85,000 a year and your employer matches up to 3% of your salary, they'll give you $2,550 in free money. If you contribute 10% of your $85,000 income to your 401k, you'll pay taxes on only $76,500 instead of your entire salary. Step 5. Maximize retirement accounts. After maximizing your employer match with your 401k, contribute to a Roth IRA. Unlike the 401k, where contributions are pre-taxed, Roth IRA contributions are taxed post-income, which means you'll first pay taxes on your $85,000 salary before adding to your Roth IRA. The advantage of a Roth IRA is that you don't have to pay taxes on any of the earnings, and you can withdraw contributions at any time. Step 6. Invest with a taxable brokerage. Once you've taken advantage of your retirement accounts, it's time to invest in a regular taxable brokerage. Unlike the 401k and Roth IRA, there are no specific tax benefits, but it's still one of the best places to invest your extra cash. You can focus on low-cost mutual funds for the long term. Long-term investing means not checking your account frequently and not stressing about market fluctuations. People often make the mistake of trying to time the market, pulling their money out when things look bad, and waiting for the right moment to get back in. The problem with this approach is that no one can predict the market's direction. The best strategy is to invest a fixed amount monthly, regardless of market conditions. Consider you invest $150 into Microsoft stock monthly for 4 years. You'll buy more shares when the price dips and fewer when it's high, which lowers your average cost per share. Let's assume you invest $75 monthly in Genie Enterprises. In the first month, shares are $12, then $6 the second month, and $18 the third. After 3 months, you'll have approximately 19 shares with an average cost of $11.87. You might not get the lowest price, but you'll steer clear of paying the highest. Step 7. Reclaim your time. Time is the most valuable resource. In economics, this is known as opportunity cost. Time spent on one task is time not spent on another. If you spend 4 hours on a weekend doing grocery shopping and cooking, you could use that time to work on a personal project. If you can earn $100 in those 4 hours and pay $40 for meal delivery, outsourcing could be more efficient. Use the difference to invest, grow your money, and buy more time to enjoy life. Write down tasks you dislike, such as cleaning, mowing the lawn, or driving far for groceries. Write down how much time it takes and how much you could earn working instead. Then, look into the cost of outsourcing these tasks. Step 8. Automate your finances. Most people handle everything manually, from paying bills to saving for a house to investing. The problem with this is that it requires dedicated time and brain power. In psychology, this is called decision fatigue. Making many decisions in a day reduces the quality of each subsequent one. In the morning, you might make great choices, but by the evening, after thousands of decisions, you might make ones you later regret. But what if I told you that you could automate your finances to save time and avoid these mistakes? Setting up automatic transfers will save you so much time and stress. Nowadays, people don't worry about whether their bills are paid or if they invested this week. They don't track anything because it's already done. Here's how. First, have your paychecks automatically deposited into your checking account. Then, set up automatic transfers with your bank to move your paycheck into 2 new accounts: a spending account and your savings account. The spending account covers recurring monthly expenses like rent, groceries, fuel, and a nice treat like your favorite pizza. Set specific spending targets for discretionary items like dining out, entertainment, and new clothes based on your usual monthly expenditures. At the month's end, automatically transfer the leftover funds into your second account, your savings. This account should then be used for whichever financial goal you're working toward, such as building an emergency fund, reducing high-interest debt, or investing for future opportunities. Even if you follow these steps, remember that managing money is about progress, not perfection. You're likely doing better than you think. I hope you liked this video. Make sure to subscribe to see more content like this. Also, share this video among your friends so that they can manage their money properly. If you want to know about the best online businesses in 2024, click this video.